What is going on, YouTube? I'm Mike with Penner Investments, and today I'm going to discuss trading put credit spreads. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. Alright, let's jump in. Put credit spreads are my favorite strategy next to trading the wheel strategy. I trade put credit spreads each week, and this allows me to put cash in my pocket week in and week out. I like these trades on solid companies that are not going to come crashing down, or on some of the ETFs like the SPY or the QQQ. The first thing I like to do is wait until the stock or ETF has a 2% pullback or greater. Let's look at an example of Salesforce, ticker symbol CRM. It hasn't quite hit the 2% mark, but I'm going to use this as an example so you can see how this works. I pull up the options chain and go out to the closest expiration to the 45-day mark. Then I go to the delta column, which is all the way over on the right. The delta shows me a couple of things. How much the option moves for each dollar move in the stock. And the second is the percent chance of this option expiring in the money, which is what I care about when I'm trading a credit spread. I like the delta that is closest to the 15% mark as possible. This means I have an 85% chance of this trade being a winner if I did nothing else to increase those odds. You can see the $180 strike has a 16% delta. This would be the option I sell for a credit, and the next $5 lower strike, $175, would be the one that I purchased to create the spread. Since it is lower, it will be cheaper than the credit I took in from selling the 180 strike, making this a credit spread since I took in a credit. That's where it gets the name credit spread. The credit is 68 cents or $68 for each contract, since options are all dealing with the 100 shares. And I always like to trade 10 contracts on these, making my credit $680 for this one trade. This is the nice thing about credit spreads, as you can adjust the number of contracts based on your account size and risk tolerance. I don't like to put too many on one stock. I usually put 10 contracts on one stock, and then if I want to do another credit spread, I move on to a different stock or ETF to just diversify over several different trades and not put all my eggs in one basket. Then, of course, you have to pay any brokerage fees after you took the credit. Then you just sit back from here and manage this trade. I like to keep things simple for managing the trade. If the stock pulls back below my higher strike, here would be the $180 strike. I close the trade to minimize my loss, as I do not want to take a max loss on this, because for 10 contracts, the max loss would be $5,000 less the credit that I took in. So the max loss would be, right around 43.20 or so. And I want to minimize any losses that I have. If I did trade one of these over earnings, I close it before the earnings if I believe the stock trade is at risk, especially if it's kind of close to the money. If it's kind of ran the other way and it's nowhere near the money, then if I have a good feeling about it, I'll let the trade continue over earnings. But for the most part, I try and stay away from earnings for these trades. Other than that, I just sit back and wait for the options to expire and keep 100% of the premium. I also do a few of these trades on the QQQ and SPY, as I'd mentioned, as another way to minimize risk by trading these options over ETFs instead of just single stocks, as those two ETFs are diversified over many companies. As always, if there's ever anything you'd like me to discuss further, drop a comment in the box below. Thanks for watching, and good luck trading.